The price on your screen is a lie. It is a carefully managed illusion, a digital placeholder in a system straining under the weight of its own contradictions. Right now, silver is trading at 85.15 per ounce, but that number, the one flashed across terminals and quoted in headlines, is becoming untethered from reality. Because while that paper price ticks up and down, a seismic rupture has occurred in the foundational plumbing of the global market. The Chinese government, in a move of sheer necessity, has been forced to take emergency action. They have suspended trading not once, but twice in the span of 8 days. The target was the only silver futures fund available to over 1 billion citizens. This was not a routine adjustment. This was a containment procedure. It tells you that the demand for real, tangible assets has surged beyond the capacity of the paper systems built to contain it. This is the story of that rupture. This is about understanding why a sovereign nation would halt its own market, and what that desperate act reveals about the hidden war between paper and physical, between representation and reality. The official action is a document of fear. On January 30th, Chinese financial authorities executed a coordinated freeze. The UBS SDIC Silver Futures Fund was locked. No trading, no entries, no exits. Simultaneously, 4 oil-focused funds were suspended. The reason given by regulators was the prevention of systemic risk and imminent massive investor losses. The specific mechanism was a premium. The fund's shares were trading at a staggering 36% above the net value of the silver futures it held. Think about that arithmetic for a moment. Investors were so desperate for exposure, they willingly paid over 1/3 more than the underlying assets were worth. This creates a financial trap. If you buy at a 36% premium and the price of silver does nothing, you are instantly down 36% the moment that premium evaporates. The regulators saw this unsustainable frenzy. They saw a feedback loop where a rising premium attracted more buyers, which pushed the premium higher, creating the appearance of endless momentum. Their intervention was a circuit breaker, an attempt to prevent a collapse that would wipe out a generation of retail investors. But this action, while framed as protection, is a confession. It admits that the market mechanism has broken. The ordinary process of price discovery has been overwhelmed by a flood of capital seeking a single, narrow exit. This was the second emergency halt in 8 days. Whatever they tried to fix the first time failed. The pressure returned, stronger. This tells you the demand is not a speculative whim. It is a torrent. And when you dam a torrent in one place, the water does not vanish. It seeks new paths with greater force. To understand the magnitude of this, you must see the 2 parallel worlds of silver. There is the paper market, a realm of digital contracts, futures, ETFs, and funds like the one China just shut down. In this world, prices are set by the trading of promises. The sheer volume of paper silver that changes hands every day dwarfs the entire annual physical supply of the metal. It is a world of leverage and speed. Then there is the physical market. This is the world of vaults, of bars, of coins, of the actual metal that goes into solar panels, electronics, and jewelry. This world moves slower. It is governed by logistics, by shipping, by the actual mining and refining of a tangible thing. The 85.15 price is a paper price. It is the agreed-upon value of a promise. The physical market, however, has begun to speak a different language. It speaks in premiums. When you walk into a dealer and ask for a silver coin, you do not pay 85.15. You pay 85.15 plus a premium that covers fabrication, distribution, and dealer profit. That premium is the translation fee between the paper promise and the metal reality. And that premium has been rising. Reports from major dealers show a 158% increase in sales of 1-ounce silver coins in less than 4 months. Demand for 1 kilogram bars is up 550%. These are not subtle shifts. They are surges. The Chinese action makes this contrast stark. Their investors, blocked from the paper funnel, will now seek other avenues. Some will turn to physical, others will seek paper exposure in Hong Kong or other jurisdictions. This redirects the torrent of demand directly into the global physical supply chain, which was already tightening. The paper market and the physical market are supposed to be arbitraged into alignment. But what happens when the paper gates are slammed shut by regulators? The physical market must absorb the shock alone. This leads us to the vaults. The supply-side data is where theory meets the unyielding truth of inventory. The global silver market has run a structural deficit for years. More silver is consumed by industry and investment than is mined. This gap is filled by recycling and, crucially, by drawing down above-ground stockpiles. These stockpiles reside in vaults, in exchange-approved warehouses like those tracked by the COMEX in New York or the London Bullion Market Association. These vault numbers are a heartbeat monitor. When inventories rise, it suggests ample supply. When they fall, it indicates strain. The trend has been clear, a long, steady decline. The drawdown has been managed, often quietly, but the trajectory is downward. When you combine this enduring physical deficit with an explosive, event-driven surge in investment demand, the kind that creates 36% premiums in China, the math becomes urgent. The system is balanced precariously. The paper markets create the illusion of infinite liquidity. You can sell 1 million ounces with a click, but if every click represented a demand for actual metal, the system would seize. The vault data whispers that the buffer, the shock absorber between paper promises and metal delivery, is thinning. China's emergency halt is a reaction to a paper market crisis, but it is implicitly a comment on this physical reality. The regulators likely understand that the ferocious demand in their paper fund is a symptom of a deeper hunger for something real, something that cannot be printed or suspended. By shutting down the paper release valve, they may have inadvertently increased pressure on the physical vault doors everywhere else. Why would banks and institutions participate in a system with such tension? The motives are complex and largely neutral from a systemic perspective. The modern financial architecture is built on the seamless functioning of paper derivatives. Futures contracts, ETFs, and funds provide liquidity, price discovery, and hedging tools for industrial users. For the institutions that facilitate this, it is a business. They provide a service, they make markets. Their goal is not to suppress or elevate price per se, but to maintain orderly function and collect the spread. However, this role places them in a delicate position. They are the intermediaries between the vast paper world and the finite physical one. When extreme dislocations occur, like a 36% premium in a major economy, it threatens that orderly function. It exposes the inherent fragility of having a mountain of paper claims resting on a molehill of metal. The institutions, therefore, have a vested interest in management, in smoothing, in containing volatility. They may engage in activities that, to an outside observer, look like suppression, selling futures contracts to cap a rally, for instance. But within their framework, this is often about risk management and maintaining the integrity of the market structure itself. They are not necessarily villains in a conspiracy. They are mechanics trying to keep an overheating engine from throwing a rod. The problem arises when the underlying demand is not speculative noise but fundamental force. You cannot manage a tsunami with a sandbag. China's regulators just threw a very large sandbag. The institutions globally are watching, because that action acknowledges the tsunami. For the retail investor, this creates a profound psychological landscape. It is a scene of confusion, of conflicting signals. On one hand, you see a powerful price rally, stories of massive demand, and a compelling long-term narrative about industrial use and monetary hedging. On the other, you see emergency trading halts, warnings of imminent massive losses, and the visceral fear that you are buying at the top. The emotional pendulum swings between greed and fear, between the fear of missing out and the fear of losing everything. The sight of Chinese investors paying a 36% premium triggers a thought, they know something I don't. I must get in. The subsequent trading halt triggers another. The authorities know it's a bubble. I must get out. This whipsaw is debilitating. It leads to reactive decisions, to buying high in euphoria and selling low in panic. The empathetic truth is that navigating this requires separating emotion from evidence. The evidence says demand is structural and powerful. The evidence also says that when a market moves 58% in 30 days, it becomes volatile and prone to sharp corrections. The retail mind wants a simple directive, buy or sell, but the situation offers no such clarity. It offers only weighty probabilities and significant risk. The Chinese investor, now locked out of their fund, feels this acutely. The global investor, watching from afar, feels a version of the same anxiety. The central psychological challenge is to resist being swept up in the narrative of either perpetual boom or imminent bust, and to instead understand that you are witnessing a complex system under extreme stress. So, where does this leave us? Let us consider scenarios, not predictions. In one scenario, the Chinese trading halt succeeds in cooling domestic speculation. The premium collapses. The redirected demand into physical markets and other jurisdictions is absorbed without incident. The paper and physical markets resynchronize. Volatility decreases and the price continues its upward climb in a more orderly, managed fashion. This is the soft landing the scenario regulators hope for. In another scenario, the halt is a temporary dam. The demand pressure continues to build globally. Physical premiums rise sharply as Chinese capital and global awareness push into tangible metal. The declining vault inventories become a focal point. The paper markets, sensing the physical tightness, become increasingly volatile. Each attempt to manage the price through paper selling meets with stronger physical buying, widening the disconnect. This leads to a series of escalating dislocations, more trading halts in other markets, and a violent repricing event where the paper market scrambles to catch up to physical reality. In a third scenario, the geopolitical and monetary pressures driving the flight to hard assets intensify. The Chinese action is seen as a leading indicator of a global phenomenon. the loss of confidence in purely financial instruments. Demand becomes a stampede, not just for silver, but for a category of real assets. The system of paper claims faces a legitimacy crisis. This is a paradigm shift, a change in how value itself is perceived. These are not forecasts. They are lenses through which to observe unfolding events. China has given us a critical data point. They have shown that for the second largest economy on Earth, the demand for a simple silver futures fund became a systemic concern. That is not a small thing. It is a tremor. Whether it remains an isolated tremor or the first shock of a larger earthquake depends on the unresolved forces beneath the surface, the depth of the physical deficit, the persistence of global demand, and the enduring faith in a system where paper always seamlessly converts to metal. The 85.15 price is the calm digital readout on the dashboard, but in the engine room the alarms are sounding.